Hello and welcome to the first lecture in Accounting 211. So we have lots of wonderful accounting information that we are going to discuss this semester, and it'll really give you a good base as to what accounting is and a lot of really important things to know about accounting, so that whether you're an accounting major or you plan to go into a completely different field, you can have very educated conversations about assets, liabilities, about the way that the financials work. And this will just be beneficial regardless of what field you end up studying, what field you end up majoring in. So we're going to go ahead and get started with what accounting is. Okay, so you've probably heard of accounting, but some of you may have never taken an accounting class before and may not really have a good grasp of what accounting is. So really, it is a means to an end. Okay, so accounting is not the end result. Accounting is all of the financials, keeping track of every transaction that's happening in a company, keeping track of all of the cash they have, all of the beneficial financial assets they have, all the money they owe, keeping track of taxes, keeping track of every transaction, every sale, every expense. This way, a business can really see if they are making money or losing money, if they are making wise investments, if they are keeping too much inventory on hand, if they're charging enough. So many wonderful things that accounting information tells people. But that accounting information is the means, the decisions that people use to make, the decisions people use the accounting information to make is the end. So all of that information helps, whether it's internal people, and we'll talk about who those people are, or external people. They use the financial statements, they use the accounting information as a means to arrive at lots of different decisions. So the decisions are the end here. So accounting is just great information to make very educated decisions. So here we're going to look at kind of the cycle of accounting and how it's so beneficial in a company. We'll start over here at economic activity. So economic activity is everything that happens in a company. This is when you deposit something at the bank. This is when a customer purchases an item. This is when the company purchases inventory. When a company sells something, when a company buys a machine, whatever is going on, this is all of the economic activity. All of the transactions going on within the company is the economic activity. So that information is all recorded, and that's the accounting aspect. And there is accounting judgments. Everything is not completely black or white, right or wrong. There are judgments that accountants learn as they go through all of these courses and different standards they have to uphold. So as they make these judgments and how to record them, when do we recognize revenue whenever we make a sale? When do we record the expense that we have incurred? When all of that is determined and recorded, that gives us the useful information. It gives a company useful information that can then be used to make good decisions. So whether that's the managers inside the company or investors outside of the company, all of that accounting information from all of the economic activity that's happened in the company is ultimately used to make good decisions, which then we can cycle back around. Those good decisions will hopefully help us to have even better economic activity, to make more profit, to make more sales, to make wiser decisions on where to put our money. So it's just a cycle. We just keep going around here. We've got the economic activity happening. We've got accounting judgments taking place that gives us useful information to make good decisions, and then that's put back into economic activity and start all over again. So that's sort of the cycle here as to how accounting information is used. And you've probably heard of some different types of accounting. Most people, when they hear accounting, when somebody hears that you're an accountant, they think it's all taxes. Oh, you do taxes. Can you tell me this about my taxes? Oh, I bet you are really busy during this season. Well, all accounting, believe it or not, is not just tax accounting. There is obviously tax accounting, it's very important, but that is just one type of accounting. And that can be calculated very differently than what companies keep in their regular financials because tax accounting has different protocol. So what we are mainly going to focus in Accounting 211 in this semester is financial accounting. So financial accounting is all of these financial reports, financial statements that are ultimately for outside users, for external users to make good decisions. Then there's also management accounting. That's what you'll focus on more in Accounting 212. That is for the internal users to make good decisions. A lot of times that management accounting gets way more detailed than the financial accounting. The management accounting is more detailed because they want to see things like, is this product making more money than this product? If we're selling glass bottles of Coca-Cola and plastic bottles, which one is more profitable? And which one do people want more? Which one should we focus our marketing efforts on? So that's one thing they figure out in management accounting. In management accounting, they would determine a budget, so a forecast for the sales, a budget for all of the expenses, and then they would compare those and see how they're doing. So management accounting is really going to break out all the accounts and get into the nitty-gritty so that managers, executives, supervisors, employees can make educated decisions. Financial accounting is more of the overall look at it so that the external users, they don't need all the details about which product made the most money. They don't need to know if your marketing department met their eating out budget. You know, they don't need all of those details. So financial accounting is more a higher look at it for people outside of the company. So that's what we'll really focus on in here. And we're not really going to look at tax accounting much at all in financial or management accounting. So you can breathe a breath of relief for that, because I know tax, that word is very intimidating, and that may be something you study more later on. Like to do these fun little transitions. All right. So it doesn't matter what kind of company it is, whether it is a mom and pop ice cream shop on the corner of a little downtown area, or if it is Coca-Cola or Google or Amazon, or if it's a company that maybe has 500 employees and does a good amount of business. No matter what kind of company it is, they all need accounting systems. These are information systems that are going to give the company and other users good information that they can use. Now, depending on which kind of company it is, it depends on how much money, how cost effective it is for them to buy a big accounting software where there's lots of users and they can put in all kinds of detailed information and there are millions of transactions available to happen within this accounting system. That would be great for Amazon. They would obviously utilize that, and they really need to keep track of sales and returns, and they've got millions and millions of products, as I'm sure we have all experienced as we've scrolled through the wonderful things that Amazon offers in 2-day delivery. But if it is that mom and pop ice cream shop, it would be ridiculous for them to spend thousands of dollars on that big accounting software that Amazon would want to use. Instead, that mom and pop, they may want to just record it on a piece of paper. Maybe at the end of every day, they record, we sold this much in ice cream. It cost us this much to buy the ice cream. That means we made this much money. Oh, we also sold a few candy bars that were sitting at the counter. Maybe we sold some little trinkets, some little magnets for Greenville, South Carolina, or something like that, Spartanburg, South Carolina. Might be pretty easy for them to keep track of. Or maybe they keep track of it in Excel. Excel is a wonderful tool that you should definitely learn how to use because it is so beneficial to use Excel. No matter what industry you end up in, Excel can be very handy. So that might be something that a company that's small would use. And it all has to do with what that company needs and if it's going to benefit them cost-wise. There's no reason for a tiny company to spend thousands and thousands and thousands of dollars on accounting software that they're not going to use much of. So who are the users of this accounting information? So this could be investors and creditors. These are people outside of the company. These are people who want to see how much money the company's making. So they're going to look at the financial reports that are going to be produced from this accounting system. The managers are obviously going to use the accounting information, these information systems, because they want to see what's going on, if they're making good decisions, and if they are making profit. And the owners obviously are very interested in that as well. They've got money invested. The customers may have access to this information depending on what kind of company it is. Amazon, the customers are using different systems in order to order the information. So they have their hands on it a little bit. And then the employees may have some interest in it and they may use that information as well. So what kind of financial information is being provided from these ultimately? So ultimately, we're going to know the profitability. So did the company make money? And if so, how much did they make? We want to know the financial position. We're going to get into this more later on in this chapter, but the financial position, we're talking about how many good things does the company have going for them? How many bad things the company have going for them? What kind of assets and what kind of debt do they have going for them? And then there's cash flows, kind of self-explanatory there with cash flows. How much money is coming in? How many customers are paying us money versus how much money do we have going out? This can be very simple with a mom and pop type place with that little ice cream shop in the corner that we all love. Or this can be super complicated with a big company that maybe doesn't collect cash at the same time that the customers purchase something. Or maybe they don't actually have to spend cash right when they incur an expense. And we'll get into that. I think it's chapter 4 in this class. But that's a lot of the big overall financial information that's provided from these accounting systems. What kind of decisions do we use all of this information for? We said that accounting was a means to the end, and the end is the decisions we make. So decisions that we might use this financial information for be like performance evaluation. So maybe this is for the salespeople, and maybe they're getting commission off of the profitability. Or maybe it's for the managers, and they say, look, depending on how much your department makes, we're going to give you a bonus. Or maybe you get some kind of, I worked for a company where I can't remember what the goal was, but if we sold a certain amount of items, we were all going to get a big screen TV, which at the time I think was 36 inches. I was very excited about the possibility. Okay, 36 inches was pretty big at that time. But if we met this certain goal, then we would be able to all get this 36-inch TV, which unfortunately we did not get. So, and then also for these stock investments, okay, so that's decisions that investors are going to make. Okay, we're looking at this financial information. We see that this company is making good decisions. They're making lots of profit. Maybe they're paying out dividends. Their stock is increasing. I want to invest in this company. That's a decision that would be made off of this information by an investor. And then there's tax strategies. So again, we're not going to get much into tax here, but there are certain things we can deduct, and certain times we want to recognize expenses. Maybe we want to make a big purchase in a certain year. All of that can be decided off of the financial statements. Labor relations, so that might tell us how many employees do we need to make all of this money. You know, have you ever gone in somewhere? Sometimes we go in Firehouse Subs, and we love going there. We go almost every Sunday, and there's like 7 employees and hardly anybody in line. My husband used to be a restaurant manager, and he always gets frustrated and says, why are there so many employees in here? They're losing so much money by having so many employees here. So maybe they need to make some better labor relation decisions. Maybe they need to hire more employees. We've all been somewhere before. We're like, Obviously, they're understaffed. And if you've ever worked in a restaurant or any kind of retail, you probably work somewhere where several people called out of work and all the customers are frustrated, but they don't understand that there were lots of other problems and you're frustrated too, and it's an awful day and you can't wait to get home. I know. I used to work at restaurants as well, and it can be so frustrating. So those are labor relations decisions that can be made. And then lending decisions, this is where the creditors are going to look at the financials and say, does this company have enough money to pay off this loan? If I give this company a loan, are they making good decisions with their financials? Will they be able to pay this off? And they're going to make decisions off the financial information. So that is how and who and what the financial accounting systems will do for us, do for a company. All right, internal control. So there's 5 different components of internal control that basically it's what it sounds like. Internal, so we're talking about inside the company, we're talking about managers, supervisors, employees, executives. What's going on inside the company? Do they have control over it? And what do they need to change? What kind of risks are coming up? So first there's the control environment. That's what it sounds like, the whole environment. How are the managers doing at making the employees feel motivated? If you work somewhere where you've got slick, sly managers, you're going to end up with slick, sly decisions made a lot of times by the employees. If you've got a company that's super greedy and everybody sees the company's making tons and tons of money, but they won't even provide nice toilet paper, I don't know, or they don't ever give any kind of bonus for Christmas, you can get a very disgruntled situation, lots of employees upset. If you have a company that's very honest, they set that tone that honesty is important and our employees are important and we want to treat you well, we want to treat our customers well. That is that control environment. So we have to also do a risk assessment at different companies. So you have to identify that every company is going to have certain risks. Let's say there's one cash register and there are 3 people that have their hands in that cash register. They don't have their own cash register. And if money were to go missing, we would have no idea which of the 3 people had taken it. So that's a risk. Maybe you have somebody who's making bank deposits and also reconciling, and we'll talk about that more in this semester, but reconciling the bank statement. Well, what if there's anything shady going on? They can hide it better because they have their hands on both things. So those are some risks that need to be acknowledged and need to be addressed. That's where we get into our control activities. So we identify risks and then we take measures into our own hands to control the situation the best we can, to mitigate that risk, to lessen the risk. So for the cash register situation, maybe you say, you know what, these 3 employees need their own separate cash registers. That way we know that Johnny over here is being honest, Sally's being honest, but maybe Cynthia is not being honest. We know that her drawer keeps coming up short. Or maybe they install a camera on the cash registers. I've worked at a company where there were 2 registers, there was lots of cash in those registers, and there were cameras on them, but there were lots of people that had their hands in those drawers. Whoever happened to be standing behind that counter, there might be 10 different people, could take payments. There did end up being a lot of money missing. And there was a brand new employee, of course, and they were able to watch the videos back to make sure it was her that was stealing the money. So that risk had a control that went along with it, those videos, in order to see who was stealing the money. Maybe at the company where they have one person depositing the money and also reconciling the bank statement, maybe there they need to split those duties up. They need to say somebody needs to make a deposit and somebody different needs to go in and reconcile that, because that would reduce that risk of that person doing something sneaky. So then we get to information and communication. So here, all of the different information that those financial systems give us, we can use those to make wise decisions for internal control, communicate those to the employees, communicate positive, truthful, ethical decisions to the employees to make sure that everyone is on the same page and we can use all that information for that. And then monitoring activities, anytime we have lots of decisions, we have lots of things implemented, we don't just walk away from that. You always want to look back and monitor it. You always got to look back and say, okay, are those control activities helping to lessen the risks? How is our control environment? Are we setting a good tone? Are we doing good at communicating? So monitoring activities are just going back and taking a look. Okay, how are things going? Are we still doing good here? Are we still making good decisions? That's what we're talking about with monitoring activities. So these 5 components can really help out with internal control, making sure things are running smoothly, efficiently, effectively, and that's what you ultimately want in your business. All right, so I told you I'm going to tell you who the external users of accounting information is. Okay, this is the last slide we're going to cover in this lecture, and then you can watch the next lecture for chapter 1 to finish it out. So external users of accounting. So these are the people that we are mainly focusing on in this Accounting 211 class. These are the people outside of, external of the company that are going to be looking at the financial statements. So we have the owners. Here we're talking about owners that are probably not super involved, okay? They're not wanting to look at all the details the way that managers would want to. These may be owners that they've all invested their money, and maybe they're somewhat involved, but primarily they just want to see the basic financial statements to see how their company is doing. Then there's creditors. So those are the people handing out that money. These are the people who are giving loans, who are saying, yes, we will give you a loan to get that building or to get that piece of machinery or that automobile. So they definitely want to see the financial information to see how likely it is they're going to get that money back. They're going to have those payments made on time. So they want to see how you're doing. Investors, so those are people looking at putting money into the company, buying equity into the company. They might be buying stock, they might be investing in other ways, but investors want to know what kind of return are they going to get on their investment. Then there's suppliers, so these are the people that you're getting your inventory from. So they want to know also if they're going to get paid for that inventory. A lot of times with suppliers, they'll go ahead and give a company the inventory and say, you have to pay me in 30 days. So they need to know that they are going to get their money back. And then there's customers. So customers want to see that information too. They may not want to see as detailed, it all depends. Right now, a big thing is with customers is wanting to see where is the company spending their money? Where are they giving charitable contributions? Are they making green decisions? These are things that are very relevant that a lot of customers want to look at financials for. Is this company going to morally be equivalent to what I find important? Are they giving to things that I find to be important? Are they giving to things that I completely disagree with and I don't want to be a part of? So that's one way that customers are going to be interested in that financial information. So that's a list of the external users. Join me again for the next lecture for Accounting 211, where we talk about what that information is that these external users are going to be provided with, and a little bit more on top of that.